Welcome back, traders. In today's breakdown, I will take you through one of the cleanest smart money concept trade setups, step by step, using the 1-hour time frame. Everything you are going to see is clearly marked on the chart. We will start with the break of structure, then move into the liquidity sweep, the bearish order block, the inducement, the sell-side liquidity, and finally, the precise point where the sell trade is executed. This is a complete sequence of how price delivers when institutions shift the market from a premium level down toward discounted liquidity. So watch closely as we move through each stage of this trade setup in a simple, clear, and professional way. Let's begin with the break of structure. Before the break occurs, the market was moving upward in a bullish sequence. It was forming higher highs and higher lows, showing that buyers were in control. However, this momentum weakens and the market creates a new move to the downside. This bearish move breaks below the previous higher low, creating what we call the break of structure. This is the first confirmation that the market is no longer maintaining bullish strength. A break of structure on the 1-hour time frame is extremely important because it often signals that the trend may be reversing or at least preparing to create a deeper pullback. This first break is the beginning of the entire setup you see on the chart. After the break of structure, the market pulls back, and during this pullback, price moves above the previous high. This move is not a continuation of the bullish trend. Instead, it is a liquidity sweep. The market intentionally reaches above the previous high because that is where retail traders place their stop-loss orders. Institutions use this liquidity as fuel. They take out those stops, collect the buy-side liquidity, and immediately reverse the price. The liquidity sweep that you see marked on the chart is a classic signature of smart money. It shows that the market is collecting liquidity before pushing price in the opposite direction. This sweep also helps us identify the zone where a premium sell opportunity will form. Once the liquidity has been swept, we see the formation of a bearish order block. The bearish order block represents the last bullish candle before the strong bearish move begins. This candle shows where institutional traders placed their final buy orders before shifting to heavy selling. This zone becomes our premium area of interest because price often returns to this zone to rebalance orders before continuing lower. On the chart, you can clearly see that price comes back into this exact bearish order block after the liquidity sweep. This return is not random. It is price revisiting the area where institutional orders were left unfilled. This bearish order block becomes a key level from where the market is expected to react and begin its downward delivery. Before price fully taps into the bearish order block, notice the smaller high that forms right below the zone. This smaller high acts as inducement. Inducement is a manipulation technique where the market creates an obvious level that attracts retail traders into taking early trades. Many traders attempt to sell from this smaller high, thinking it is the main rejection point. But the market uses this as a trap. When these early sellers place their stops above the inducement high, they create new liquidity. The market then pushes up, takes out that inducement, and only after collecting that liquidity, price taps into the true bearish order block. This inducement confirms that the market respects the institutional zone rather than the levels retail traders choose. Now let's look at the target for this move, sell-side liquidity. Sell-side liquidity is found below equal lows, structural lows, or areas where traders place their stop losses for buy positions. On this chart, you will see the sell-side liquidity marked clearly at the lower end of the structure. This is the pool of liquidity that the market aims for after reacting from the bearish order block. Institutional traders always push the market from liquidity to liquidity. So after collecting liquidity above during the sweep and inducement, the natural target becomes the liquidity below. This sell-side liquidity becomes our take-profit zone for the sell trade.
Once price taps into the bearish order block and takes out the inducement, the reaction begins. This is the exact moment to enter the sell trade. We enter the sell position as soon as price shows rejection or confirmation inside the bearish order block on the 1-hour time frame. The direction is already clear. The break of structure confirms bearish intent. The liquidity sweep provides the manipulation. The bearish order block provides the premium entry point. The inducement provides the liquidity grab, and the sell-side liquidity provides the final target. Price then moves cleanly from the order block all the way down into the sell-side liquidity zone. This completes the entire institutional delivery model. If you want more deep smart money concepts breakdowns and want to master institutional trading models, make sure you follow Discount Trader for more complete step-by-step explanations. Thank you for watching, and I will see you in the next video.